Kia ora koutou, I'm Satish Ranchod. Welcome to our weekly look at the New Zealand economy. Recent data has highlighted the ongoing pressure on household finances. Over the past year, we've seen some big increases in interest rates, and while we don't expect that the Reserve Bank will hike the OCR again, we're still seeing a number of households rolling off earlier lower fixed mortgage rates. And that does mean some increase in interest costs over the year ahead. At the same time, we're continuing to see some large increases in consumer prices, especially for items like housing. Those conditions mean that the pressure on households' purchasing power has continued to build, and we've seen softness in retail spending. In fact, in most parts of the country, retail spending growth has slowed below the rate of population growth, meaning many households are taking home fewer goods and services. Importantly, the labour market is now softening. We expect that the upcoming labour market report will show that unemployment has lifted from 4% to 4.2% in the March quarter, and we expect that unemployment will rise to 5% by the end of this year. Now, that combination of conditions does mean some tough times ahead for many New Zealand families. However, for the economy overall, we expect that the slowdown will be manageable. While we've seen some big increases in interest rates, that's been from record low levels. And if we look at the amount that households are actually spending on debt servicing costs, rather than being very high, it's back around the averages that we saw prior to the pandemic. Finally, in terms of the labour market, while we are seeing a rise in unemployment, that's expected to be more moderate than during previous downturns like the global financial crisis. Put that all together, and while we do expect to see some slower economic conditions over the coming year, it's likely to be more moderate rather than a sharp collapse. That's it for me this week. We'll talk to you next time. Ka kite anō.